Assalamu alaikum everyone. Good morning. Welcome to all my ICAP members. Welcome to the webinar on the introduction of corporate tax in the. First of all, thank you so much. You guys are up early and starting the weekend with us. Thank you so much for a good attendance. So what we are talking about today, it's a very important and informative topic. It's a very interesting time for us in the industry. And we are all facing the corporate tax implementation in our organization or wherever we are working in the consultancy or anywhere. I guess it's a very interesting time because we are looking at corporate tax from the scratch. It doesn't happen like every day that we get to see an implementation of corporate tax in a country like from scratch, and then you get to see it grow and get mature. So we have a very amazing panelist and keynote speakers today. I'll just give you a layout that we will talk about corporate tax overall, and then we will have some question and answers. We will take some questions from you directly, and our panelists will answer them. So our first speaker, we have Abi Man Joshi. He is business tax partner in Deloitte, and he's gonna take us through the corporate tax, what's the overall overview about it, and then how it can have some important considerations to our businesses or industry, and how it can have some implications which are very spotlight and important. So I'll give the space to Abhiman now, so he can take us through the corporate tax concepts.
Thank you so much. ICAP, this has been a great presentation in terms of introduction. Thank you so much. And sorry for the technical glitches in the Zoom thing. So there was some technical error. But anyway, so here we are. My name is Abi Joshi. I am a UAE business tax partner, been in the region for 3.5 years. And prior to that, I was based in US, where I was focusing on the corporate tax, the compliance, advisory, and what have you, right? So first things first, we know that UAE is part of the OECD's BEPS Inclusive Framework member country, and UAE is part of this membership. It's been a while, and since just recently, OECD has introduced the introduction of the global minimum tax of 15%. Where all the countries are also 140 countries are part of it. And it's one thing for UAE to agree with the OECD to sign a treaty to have a global minimum tax of 15% and not do anything back at home, right? That is one of the reasons why UAE introduced the corporate law number 47 of 2022, starting for financial year effective from June 1st, 2023. We had a public consultation document came out in April. Then we had the law that was just released back in December 2022. It has 18 chapters, 70 articles, and 41 provisions that are still not yet, clarified, which needs to be clarified in the cabinet decisions. Not to mention, Ministry of Finance also has issued 158 FAQs, which has really helped us to analyze more detail, as we go into the details. So clearly here, this is the timing journey of the law. The law was issued on October 3rd. It was published in the official decree October 10th, and is effective 15 days after the issuance of the law, which is October 2026. And here it's effective for financial year effective from June 1st, 2023. But I understand that majority of our clients, of our companies, they have a calendar year starting from January 2024. So basically from Jan 24 till December 2024, this is where the law will be effective from. And the first filing of the tax return will be 9 months after the year end. So it will be September 2025. And here in my screen, you can see here that in line with the UAE corporate income tax, Pillar 2, which is happening at the global level, it will also be starting from 2024. While UAE has agreed to this global treaty, we don't really know whether UAE will also introduce the global minimum tax, but this is something we have yet to see because right now the rate stands only at 9%. There's a 0% rate for taxable income below 375,000, and there's a 9% rate for anything above it, right? So here, now taxable persons, we know that the law is applicable to all the UAE legal entities, all the juridical person, as well as any foreign legal entity, as long as it is managed and controlled here in UAE. Like, for example, I have a UAE headquartered company here, but then I have a branch or operations in US and UK where all the board decisions are taken by me here. Then technically speaking, that entity in the UK and the US can also be deemed to be having a taxable presence here in the UAE. And the other thing we also have to keep in mind, which has been, and I've been getting a lot of queries from my clients, is the law says it only applies to the legal entity. You know, I'm a natural person, I'm an individual, but I have tons of apartment buildings that I'm renting it out. I'm getting a commercial income, I'm getting the rental income. So since it doesn't mention anything about, you know, individual, then you know, you might think that, oh, the individual is not subject to tax, right? We have been getting that questions a lot, and it's a great question. And to be honest with you, the word corporate tax law, I believe, is really a misnomer, because the one of the article of the law also says that if a natural person you know, is conducting a business activity, a series of commercial or business activity, then if that natural person doesn't have a legal entity set up, it's in the form of a sole proprietorship, or let's say a sole establishment, then even that natural person can be deemed to be conducting business in the UAE, and therefore, you know, subject to tax. For example, if I just own one villa, you know, I'm just getting some income, but I'm working and I get a salary, then technically I should not be subject to tax. But I own an entire block of Sheikh Zayed Road where I'm earning all those rental income, then technically speaking, Abi Joshi, should be subject to the corporate income tax as well, right? So this is very important for us to know who does it apply to. And then certainly we have, you know, permanent establishment of other large multinational who has an operation here, who's deriving income, then you know, certainly this will also change. They will also have the filing requirement as well. Now, I talked about who does it apply to the law, but then the question is who is not subject to the corporate income tax, right? Because we have a lot of companies who are simply pension funds, who are charitable entities, who are government entities, who work for the oil and gas companies and all those things. So the provision of the law says that while this law is applicable to pretty much all the entities, it is exempt for government entities. It is exempt for a qualifying public benefit, qualifying investment fund, some charitable organizations, what have you, right? And as well as those in the extractive and non-extractive business. I would like to remind you that, you know, UAE already has you know, tax, you know, the Emirati level tax, you know, at the late for all these oil and gas companies, they pay tax, you know, like 40+%, what have you, and it purely applies to the oil and gas companies. So since they are already subject to the different level of tax, this law is not applicable to them. And so, you know, basically, if you have an upstream, midstream, downstream operation, the law is not applicable to them. Certainly, if you are a government entity, of course, the law is not applicable to them. But if you have a government-controlled entities that are operating in a commercial control activities, we're doing business activities, then we can't say that the law is not applicable to them. Most likely, since they are involved in the commercial control activities, you know, in the profit-making generating activity, in that case, the law could be applicable to them as well. But in any case, whether the law is applicable or not applicable, if you want to claim an exemption, you don't get the blanket exemption. More than likely, you will have to apply to seek the exemption from the FTA, from the Federal Tax Authority. So, and as a matter of fact, just recently there was a resolution came that talked about the registration. Some of our clients have already gotten the invite to register in the FTA website. And usually the registration would be coming to mostly to those taxpayers whose fiscal year starts from June 2023. But then, certainly you have certain time to start preparing for the registration and what have you. So just keeping you posted that, even these exempt entities, you can't just assume that I'm exempt and I don't have to do anything. The law is still, you have to seek the exemption in order to get the ball rolling. Now, as I mentioned earlier here, right? So what are the tax rate? As I said, 0% tax rate for income below 375,000, 9% tax rate for income above 375,000. And certainly there are two types of entities in the UAE, as we know. We have all the free zone entities such as Jebel Ali, DMCC, DIFC, ADGM, and all the mainland entities, the LLCs, right? So for the mainland entities, obviously, I just mentioned the 0% and the 9%. For the free zone entities, the rule says that as long as you are performing only a qualifying activity and you are a full-fledged qualifying free zone person, then you still have to file the tax return, you have to register, what have you, but you don't have to pay the tax return, right? And one of the interesting things that came out when the law was issued was when the public consultation document was issued back in April, it had a provision in the law that said that you can have a qualifying free zone entity, but as long as that qualifying free zone entity is getting $1 of a non-qualifying income, or let's say $1 of a bad income, that $1 of a bad income can take your entire $99 of a good income, the qualifying income, right? So that was a huge issue for our free zone companies. But now the law has mentioned that a free zone entity can have a qualifying income as well as a non-qualifying income. So you don't pay any tax on the qualifying income, but you do pay tax at the rate of 9% on the non-qualifying income. As I mentioned here on the slide, we're still waiting the cabinet decision to be issued to explain what is the definition of qualifying income. But from reading what the public consultation document says, from what our interpretation is, that qualifying income are those type of income, such as one free zone entity getting an income from another free zone entity, or free zone entity getting an income from outside of the UAE, and a free zone entity getting those passive income, that dividend income and what have you, right? So this is how I differentiate. Good income means qualifying income, bad income means non-qualifying income, and you don't pay tax on the qualifying income, but you do pay tax on the non-qualifying income, which is a bad income. Certainly, as I'm talking to the clients, it's going to be a reporting nightmare because you have to have a set of books to keep track of, out of $100 income, which one is the qualifying and which one is a non-qualifying income. Here, just to summarize, as I said earlier, the free zone entities are expected to have adequate substance in the UAE. I'm sure you may have heard the term ESR, economic substance reporting, which we have been doing for all those free zone entities that meet the relevant activities. You need to be deriving a qualifying income. That entity has not been subject to tax, and it complies with all the arm's length principle, which is really a transfer pricing mechanism. So, but here, it's interesting to keep in mind is, let's say you have a free zone entity, that is getting most of the non-qualifying income. Then there is a provision where you can try to elect that free zone entity into a taxable entity, which will, basically allow you to become as a regular entity. And that can certainly help you from a consolidation purposes, if necessary. I'll talk about the grouping rule in a second. Now, let's say if the law were out today, and let's say, hypothetically speaking, if I am calculating the taxable income, of my entity, this is basically a very high level framework of what the tax return calculation would look like, right? Your starting point is your IFRS book income from your financial statement, and your ending point is your corporate tax liability, as you see here, point number 9. So certainly, IFRS book income, whatever that income is, that's the starting point. Then you can have a situation where you are getting all those unrealized gain or loss. If you're investing in the market, what have you, then any unrealized gain or loss, that of course will be adjusted for the purpose of your taxable income. But I don't want to go into detail, but there's one nuances in here because there are two types of items. There's a capital item such as long-term assets, what have you, and there are revenue items which are like a short-term, like for example, foreign exchange gain or loss and what have you, right? The provision in the law says that you have an option to recognize the income only once they are realized, which is what we usually do in other jurisdictions, in other Pakistan, in the US, what have you. That's one way. Then the other option is that you can try to elect to recognize even the unrealized income on the revenue item, but on the capital item, it will not be able to recognize that income. But in essence, to avoid any confusion, to make it easy for the purposes of this session, most of the unrealized gain or losses, those will not be treated as a taxable item until they are realized, for that. Then we have item number 3, exempt income. Basically, this is a very important part, and I have explanation for you on the example of the participation exempt. For example, in dividend income, those are exempt. You can also adjust from your taxable income calculation. Then we have a relief. For example, if you have a large company, you're doing an internal restructuring, right? You're not selling it to a third party. You're just doing your own internal restructuring. Then as long as you meet certain rules in all those things as part of the restructuring, any gains or any gains recognized from that restructuring, that will not be a taxable item. The non-deductible expenses, certainly, any expense incurred in generating the exempt income and whatever those net interest expenses, these are also not allowed. And these sometimes 50% on meals and entertainment. And I'll explain to you in a bit what are these non-deductible expenses. But one of the key items to keep in mind is this non-deductible is the limitation on the deduction of net interest, which is subject to your 30% of your EBIT. I'll explain it to you to make it more elaborate. But anyway, I just wanted to show you the framework. You start with the book income, unrealized gain or loss in dividend income. What are the non-deductible expenses and where are the transactions, that are not allowed for deductions? You come up with the taxable income and you calculate the tax rate. That will be your tax liability, which is shown on line number 9. And let's say if you are a company which has operation in foreign jurisdictions, let's say UK or US, where your subsidiary had paid the tax in those jurisdictions, then there is an option for you to get the foreign tax credit as well, in line with the avoidance of a double taxation. So here, remember item number 3, exempt income. This is basically the example of that, right? So let's say I, as a UAE entity, have shares in a FAB bank, ADCB bank, in any other entity where I'm getting a dividend income, then that income is exempt because technically those income are already being subject to those at that entity level. So I should not be taxed again, right? That's number 1. But now the confusion can lie what happens if a UAE entity holds an operation in a foreign jurisdiction and the income you're getting from a foreign jurisdictions, will it be subject to tax or not, right? We get that questions a lot because we have a lot of outbound UAE entities. We have a lot of outbound entities in where UAE is headquartered here and they have operations all over the world. So under the participation exemption article in the law, it says that as long as you meet the participation exemption, then certain type of income such as dividend income or profit distributions will not be taxable in the UAE as long as you meet the 2 tests. One test is that you need to be owning that subsidiary greater than 5%, owning that entity greater than 5%, and that foreign jurisdiction should be subject to a tax rate of at least 9%, right? So for example, here in my example here, this is basically from a UAE to UAE example, but this is the example of a foreign subsidiary. Let's say if a UAE is getting has a subsidiary in the UK, and let's say you own that UK subsidiary 100%. So whatever the capital gain or the dividend you get from the UK subsidiary, technically speaking, it will be exempt because you own the UK subsidiary greater than 5%, and the UK already has a tax rate higher than 9%, right? But then here, let's say instead of UK as a foreign subsidiary, let's say you have an operation in Cayman Island, where there's some operation in Cayman Island and you're getting an income or dividend from Cayman Island, then technically speaking, right, because of the fact that even though you own the Cayman Island greater entity, greater than 5%, you meet the one test. But the problem is Cayman Island has a 0% tax rate. You don't meet that test, and whatever the income that flows up will be taxable in the UAE. But I don't want to overcomplicate this thing. But we may have situations where we have a Cayman Island is purely a holding company, but Cayman Island is getting from the underlying other foreign jurisdictions down below, such as US or what have you. Then what happens, if it's really the true nature of the income is coming from all the lower tier jurisdictions that have a tax rate of higher than 9% already, right? There is a provision in the law which we have to explore further to see that since it's an income is coming from the underlying subsidiary, which has a substance, which has a tax rate of higher than 9%, as long as you meet those tests, then you can argue that maybe that income should not be taxable, right? But again, this is something we have to see. It depends on your case by case situation. But this is why, to me, my favorite article in the law is participation exemptions, because it really talks not only at the domestic level, it also talks at an international level. So here, I talked about the exempt income, the participant exemptions. So item 5B, limitation on deduction of net interest expense, which is the 30% on EBITDA cap. So here, basically, we may have a company, that has a leverage, bank leverage, you may have a combination of equity and debt, what have you, but then the law says is that you can have a net interest expense, you can deduct it for your tax purposes, but guess what, guys? It has to be subject to limit. It's basically limited up to 30% of your EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization, right? So let's say if your EBITDA is $100, then technically your net interest expense should be limited to 30% of that $100. So only $30 is allowed as a net interest expense deduction. The rest, whatever the unused portion, luckily has ability to be carried forward for up to next 10 years. So you have a rolling 10-year carry forward. That's great, because when the public consultation document was out, we didn't know whether those unused interest deductions will be able to be carried forward in the foreseeable years. Certainly, we may have clients, that are in the banking industry, that are in the insurance industry, but for those type of taxpayers, this limitation does not apply. So this is one of the major book tax differences when it comes to expenses. So you will have to keep this in mind. Now, I know it looks like a lot of things is going on in this chart, but it's really simple. What it's trying to say is basically, you may have, let's say, first of all, one of the provision of the law is any losses starting from Jan 2024 onward, assuming you are a calendar year taxpayer, if you have any losses, those losses are carried forward indefinitely, right? That's number one. And let's say that in 2024, you have a loss, but in 2025, you have an income, then that loss of 2024 can be offset, can be used to offset the 2025 taxable income. But not the whole amount can be offset, only the 75% of that 2025 taxable income can be offset. So here, for example, we have company A that say for fiscal year 2025, we have a loss of $120. And in 2026, they have a profit of $40, right, in 2026. So here, as I said, the loss can be, so out of $120 loss, only $30 of the loss can be used in 2026. And the way I calculated $30 is you have a 2026 taxable income of 40 times 75% of that 2026 income, right? So basically 75% of 40 is $30. So technically speaking, even though you have a $120 loss, you cannot use to offset the entire $40. It's limited up to $30 only. And therefore, so 120 minus 30, you're still left with a $90 of that excess loss carry forward, right? So that's in a company A. But let's say hypothetically that, you are a part of a group entity, where let's say, company A owns company B, let's say higher than 75%, right? Hypothetically, then technically speaking, not only can company A can do this loss, whatever this excess loss of $90, which we use, that loss can also be transferred to another your company, as long as you meet the 75% ownership test there, right? So this is very important. The 75% of the ownership test is very important here, and both company A and company B, they have to be they cannot be one cannot be a free zone entity and the other cannot be, basically both have to be the taxable entity. They cannot be a free zone entity or what have you, right? So this is very important because you may have situations where you don't own the other companies, let's say 90% or 100%, but you own those other companies 75% and higher. So anytime you own the company 75% and higher, there is a provision where you can try to have a loss relief where one can have an income, the other can have a loss. So basically you can switch these losses. This is very important in your org chart structure, ladies and gentlemen. Now, I was mentioning about the 75% test here. Now, one of the major provision under the law number 47 of 2022, where I get a lot of questions from my clients is, Abi, I have a UAE org chart where there are hundreds of entities. There is a parent company, then I own this company, 100% here, 95% here, boom, 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 blah, 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 right? So here, article in the law says that if you own your group companies greater than 95% vote and value, and as long as they are in all taxable entity, meaning they are all mainland entities like LLCs, then you can try to group them as one entity, right? But if you have a free zone entity also in that org chart, the free zone entity cannot be grouped with the mainland entity. And also Article 30 of the law even says further that you can have a group entity with all the free zones only, right? You might think that, oh, I can group all this free zone into one free zone company. But unfortunately, Article 30, paragraph C, there's that free zone companies cannot be grouped together. So unfortunately, until we have a further guidance from the ministry, free zone companies cannot be grouped. They have to be filing on a standalone basis. But all the mainland companies, as long as you meet the 95% test, they can be grouped together, right? Which is great because think about it. Imagine, I have 100 entities. Imagine I have to file the tax return for 100 of them one at a time. It's going to be an administrative nightmare. And plus, the other reason why you want to do that is that you may have an income of one entity that can be used to offset the loss of the other entity from a most tax optimal situation, which is why grouping is also very important, element of the law. Now, certainly, there are so many things, and I know 1 hour doesn't really do justice to talk about it. So, I know I can't be talking about all the rules, but I just wanted to highlight some of the key provisions of the rules. So, basically, under the transitional rule, and as I explained to you earlier, for assuming you are a calendar year taxpayer, the opening balance sheet, which is Jan 2024, is the opening balance sheet, and the closing balance sheet, which is, let's say, from December 31st, 2023, it's expected that whatever the opening balance sheet you have, it's coming from the last year's closing balance sheet. And technically speaking, that those balances should be in arm's length manner, right? Like, what does that mean? In any case, I guess, for example, to tell you in a very simplistic way, basically, whatever the balances that's coming on Jan 1st, 2024, it is expected that all those balances, those asset, whatever the property, those would have been subject to in an arm's length manner. Meaning, like 10 years ago, let's say one of the subsidiary, one of the parent company bought the subsidiary. Let's say they bought it for only $1, but technically the fair value should have been $100. Then in your books, technically it's sitting only as $1, right? So it's not really arm's length. So this is also going to be very, very crucial topic, which have our clients asking, how do we figure this out so that all these opening balance sheet should be in arm's length. Now, the reason why I mentioned about this arm's length principle is because if you look at the timing of the issuance of the law was issued October 3rd, 2022, and it was published in the Gazette of October 10, 2022. And there is a very interesting article called Article 50 of the law, which is General Anti-Avoidance Rule, which says that rule technically has already been retroactively effective from October 10, 2022, right? And I'll explain to you what that General Anti-Avoidance Rule means. So what's this trying to say is that, as the law will be effective from 2024 onward for the calendar year taxpayers, you may have some companies that will trying to do some tax planning, what have you, purely for the tax motive reason. And the law says that under the General Anti-Avoidance Rule, which is based from an OECD principle, you can't have a transaction purely for the tax motive. It has to be done for the legal, the commercial, and the business. So there has to be the principal purpose, which should not be only tax motive. So let me give you the example, which I hope will explain to you what it's trying to say. So you have basically a UAE company, let's say, that owns a foreign jurisdiction in Cayman Island, right? Remember I said, let's say it's Cayman Island, the fact that it's an operation in Cayman Island, it doesn't meet those two-leg tests. So let's say this company is giving a UAE company 600,000 dirham of dividend. The fact that it doesn't meet two of those tests, that 600,000 of dividend will be taxable at the UAE. And let's say this UAE company is trying to be very smart and saying, you know what, rather than 600,000 going to one UAE company, why don't I give the money to the two UAE company 2 and the UAE company 1? Let's split the profit. So that way, instead of 375,000, you get the 300,000 each. And since this income is below the 375,000 threshold, which is taxed at 0%, technically, you might say, you know what, I'm getting a 300,000 each. I'm getting a 300,000 each. Since it's below the threshold, I don't get any tax, right? You would think this may work, but unfortunately not. The tax authorities, is basically trying to say is that if the only reason you are creating this another UAE entity is purely to avoid this income of 600 by lowering it by you receiving the income below the 375K so that you can get the benefit of 0% tax rate, so purely this this sort of transaction fails the general anti-abuse rules, and the tax authority will not make this transaction valid. This is just an example of how the general anti-avoidance rule works. And I have to say, and you have to please keep this in mind as well, that Article 50 is the most important article of the law. So, obviously, I talked about the grouping, I talked about the general anti-avoidance rule, I talked about the participation exemptions, I talked about all those things. But at the end of the day, okay, so what does this mean? What do I have to do? What is the next step? What are my action plans, right? The action plans are as follows. There is an administrative article in those chapters where it talks about the registration. As I mentioned earlier, some of the taxpayers have already started receiving the message either via SMS or via email or alert that they need to start doing the registration. That's number one. Certainly, the tax return is due only in September 2025, assuming you are a calendar year taxpayer. One good provision of the law is, let's say you have a tax liability, you don't have to do a quarterly payment like in US, where we have to make the extension payment. You can just pay and file all at once, right? That's number one. Let's say if you want to enter into a transaction which you're not sure what's the outcome of that transaction, there is a way where you can try to apply to the authority to get some sort of like an advanced ruling, so which is great. It's like an advanced ruling, how it's done in the US with the IRS and in the UK with the HMRC. Of course, it's in a self-assessment principle. So, the FTA may issue an assessment once you file the return, that's thing. And last but not the least is documentation, right? In today's world, so we just have to ensure that, because right now, whether the company has a $1 income or $1 million income, it doesn't matter because there's no tax. But going forward from 2024 for a calendar year taxpayer, all these transactions, the revenue, the expenses, intercompany transactions, it is expected to be properly documented in case you get audited, down the road, right? When I talk about the documentation, I would be remiss if I don't talk about the transfer pricing. Obviously, I'm not the transfer pricing expert. We have a separate team in my company where it focuses on nothing but the transfer pricing. But you can imagine that there are so many transfer pricing related articles that talk about the related parties, that talk about the arm's length principle, that talk about, what are the types of the transfer pricing methods, such as the cost plus method, the profit split method, what have you. And all these transfer pricing methods are also in line with the OECD standards and in line with the other jurisdictions such as Saudi, such as Qatar, Oman, and what have you, right? So all these intercompany transactions related party transactions, it is expected that those transactions are done in arm's length manner. When I say arm's length manner, meaning if I were to get a service from my related company, and if I need to pay my related party for that service, what would be the value of the amount I would be paid? Would it be the same amount, of the money that I would pay to someone and a completely third person on the street, right? That's called fair and equitable value. That's called arm's length. So, but certainly, we can have a separate session only for TP, given that it's also important. So I think those are the key provisions, of the law, and certainly I know that we will have a panel session as well, and we'll be happy to go over any Q&A session along with my other panelists as well. But as I wrap this thing, just wanted to summarize this in two ways. UAE tax law is coming certainly from 2024. And as we are, working on this, whether in our own profession or advising our companies, what I view, not only you have to think from a UAE corporate tax perspective, but to the extent you are a large multinational, you also have to think from a Pillar 2 perspective or something called global minimum tax perspective, right? So of course that topic requires a separate conversation, separate discussion, but I just wanted to summarize it that way. And with that, I'm yielding the floor back to Saba and the team. So, Saba, can you hear me? Okay. Yes.
Yes, Abi Man. Thank you so much, Abi Man. Very informative and very summarized aspects of the corporate tax. Of course, 1 hour doesn't do justice. It's a huge, huge topic, but thank you for covering all the basic concepts. Rightly said, yeah, not only the UAE corporate tax is coming in, we have to think about the global minimum tax if you are a big company or if you're advising a big client. Now we have panel session for question and answers. We have panel. So we have Abi Man again in the panel, and we have two more amazing members with us, Sadia Salman and Mirza Farrukh Baig. Hi, everyone. Now we will start the question and answer session. I'm sorry I couldn't ask you guys before that. Please drop your questions if you have any. We have few already. I'll start with Farrukh with some tax group questions we are having. Meanwhile, you can drop more questions to be asked. So Farrukh, two questions for you from the tax group perspective. First from Mohammed Farooq. Tax group can be formed only if 95% and more shareholding. Then what is this tax relief? And then he's also asking about transfer of tax losses having ownership more than 75, transfer within qualified group, and business restructuring relief. I guess Abi Man quite covered it, but you want to add something here.
Sure, I hope all of you can hear me. Good morning. Basically, in the CT, we have the concept of a qualifying group and a tax group itself. So a tax group, of course, the main aim is that if the ownership is up to, say, 95%,
we suddenly cannot hear you.
All the...
Yeah, we can hear you.
Are you able to hear me? Are you able to hear me?
Yes, now we can hear you.
Okay, so I was just saying that in the tax law, we have got two concepts. First one is, of course, the tax group in which the tax ownership has to be 95%. And in that case, of course, we can file single tax return. But the concept of the qualifying group is that in 5% or higher, in that scenario, we can transfer the tax losses. And in that case also, if there is a transfer of assets or liabilities in that qualifying group, and if there is a gain on that, of course, in that case, the gain also will not be taxed. And the only condition here is that the key condition is that the ownership has to be 75% or higher at the start of the tax year. So it cannot be case
Yes, we are
tax reliefs. Are you able to hear me?
Yes. Yeah, Farooq rightly mentioned, we have to see our percentage of ownerships and we have to decide between grouping on transferring of losses. Accordingly, you can see what restructuring you can have. Of course, do consider anti-abuse rules are there. So you cannot restructure in a way that, you are charged 0% and you're avoiding tax or evading tax. We have another question. What if the government entity, for Farooq again, what if the government entity or its 100% owned subsidiary are engaged in commercial operations like leasing or, any other commercial F&B outlet or anything? I guess they are trying to ask, will they still have corporate tax or no? So Farooq.
Sorry, are you able to hear me now? I think my internet was a bit down. So it is the question about the state-owned entities. It is about the
they're saying
the government entities.
Yes.
Okay, the government entities are only exempt if they are carrying on the mandated activities. But if they are carrying on the the activities which are having the commercial aspect in nature, as he has specified, that it is selling the tickets or it is selling through the F&B outlets, in that case, such entities would be taxable.
Yes. With Sadia. Also selling goods to agents in mainland. There's confusion. Is this still zero rated since sales not directly done in mainland?
This looks like a VAT question as they are asking zero rated, but I think he maybe wrongly wrote it. So if goods are sold through agents in mainland, it will still be considered as a mainland income and will be subject to corporate tax.
Okay. We have one more question. I'll hold on, Sadia, to answer that as well. A tax provision for free zone says free zone person can opt for normal rate. What can be a logic to go for normal rate?
So I feel when a law is written, they like to take a holistic picture of it. Maybe in future they might come up with some provisions which will make people want to apply for corporate tax, not avail the exemption for corporate tax. Maybe that could be the reason. But currently they have not specified anything in the law why they have put this election to opt for corporate tax.
Directly mentioned. Guys, anyway, we are still not very clear about the free zone, details about the regulations, and we might have something coming more, and we will have to see accordingly. We have some more question. One question about the tax losses, as Abi Man talked about it. I'll give it to Abi Man. How long can this loss be offset? I guess 10 years, but yeah.
No, yeah, that's a great question, right? So the 10-year carry forward, which I explained earlier, is for the net interest expense, right? The good news is the tax losses can be carried forward indefinitely. But of course, not the losses of these year's losses, but the losses from 2024 onward, assuming you are a calendar year taxpayer. Sabah, back to you.
Thank you, Abi Man. Very, very good question, actually. And yeah, the 10 years is only about interest and the rest is infinite. One more question, I'll give it to Farrukh. Tax registration related. A UAE mainland company wholly owned by foreign company, say Cayman Island, then can we do tax registration of foreign company?
Okay, so if you are just holding a company here and you will not be, deriving any state-owned income, on your own, being, a foreign company. So just holding a company, of course, will not require you to have a registration here. But in case if that, Cayman Island entity is effectively controlled and operated from within UAE, and in that case, of course, you need to have the tax registration. And also in case if that Cayman Island entity has given some sort of, IP rights to its associated entity here, and it is also, generating some income out of it. So it would also be, triggering the state source income. And in that case also, the Cayman Island entity has to get the tax registration here. But if I'm just a parent company of another entity, apparently it would not be a requirement to have the tax registration here.
All right. One more question for you, Farrukh. Is each and every LLC or sole proprietor entity registered with commercial or trade license even below the threshold need to file corporate tax return for every tax year?
Interesting. Yes, indeed, the 375K is only a threshold to decide that on what rate the tax would be applicable. But as far as the tax filing is concerned, every entity incorporated in UAE, unless specified, it has to file a tax return.
Thank you, Farrukh. Yeah, it was a very good question, actually. And yeah, we all have to register for tax. The limitation is for the tax rate, or we can have a free zone entity as well. So you have to register for tax. One more question, Sadia, I'll give it to you. What are the provisions around head office charges, expenses, any limit for admissibility?
No, there's no such limit for admissibility of head office charges or expenses incurred. But for Entertainment, they have said that it will be admissible only for 50%. So that is the only exemption. Otherwise, any expenses incurred wholly and exclusively for the purpose of business will be allowed.
All right. So guys, now you have to think about if your end users are charging properly or not. Is it entertainment expense or not? And then you can see where are you categorizing. And as Sadia mentioned, accordingly, you will put the admissibility as 50% for entertainment only. Sadia, one more question for you. In case EBITDA is 0 or negative, then can we adjust the net interest expense?
So for the interest expense, they have said that they will mention a threshold for to which extent the interest expense will be allowed. That threshold has not been decided yet. Otherwise, it is said that 30% of EBITDA. So even if your EBITDA is 0, maybe you will have to maybe you have to make sure that you don't exceed that threshold. That threshold will be decided later on through a ministry decision.
All right, thank you, Sadia. One more question. We have too many questions. That's really good. You know, people are involved and they are listening. One more question. I'll request Abi to answer this. What will be the consequences if a company subsidiary in USA and bearing tax losses but not use same GAAP? We have IFRS now though. So Abi.
Yes. So, okay, you have a UAE company that has a subsidiary in the US. Okay, so what's the question one more time, Saba? So what is the question?
So it looks like they are trying to ask that what will happen about the tax losses if you have a subsidiary in the USA. So you have a UAE company and then you have a subsidiary in USA and that company has tax losses, but they don't use the same accounting regulations. They don't use GAAP.
Yes. Can you hear me?
Yes.
Okay. No, I think okay. So I think, well, first of all, we should take a step back and say, just because you have a US subsidiary and the US subsidiary has a loss of 100 and a UAE company has an income of 200, it's, I want to clarify that US company losses cannot be offset with the UAE company losses, right? Because it's not a UAE company. I'm talking about only the UAE companies that are part of the group companies, So well, hold on. The foreign company, they cannot be used the losses. The only thing you can do is if the US company had paid a tax of, let's say, 100 or whatever, then there is a way for you to get a foreign tax credit. But those loss relief, that is only applicable to the UAE level companies, Sabah.
Thank you.
So because that US losses, what have you, that's a US tax issue. It has nothing to do with the UAE tax.
Yes. A good question, actually, and we are clearing so many concepts that when we are talking about tax losses, we are talking within UAE. We cannot have an offset from outside the UAE for a USA company. It's not that open yet. Maybe it will in the future. There is one more question. Hold on, Abi. Mr. Faimuddin. Hi, Faimuddin. He wants to ask you a question specifically. So he's saying, does the tax group definition consider legal ownership only or beneficial ownership as well, such as concept of orphans?
The question is for me?
Yes, it's for you specifically.
Okay. It's for me specifically. Okay.
Yeah.
Well, I'm honored. And actually, Saba, maybe, and again, once again, I'm so sorry, team. I know you are not able to see my face, because of the Zoom issue. Maybe, Saba, this is basically indirect way of saying is that next time we need to do a session live, perhaps. So which perhaps, we can do it, hopefully in the near future. But Mr. Faibuddin, your question that's a great question, right? And, clearly the losses that, you need to have a legal and a beneficial ownership, right? So I completely understand your question because, you can have a legal ownership there, but then you are giving a nominee arrangement for the beneficial arrangement for someone else. Yeah, I think this, because as you can imagine, as you can appreciate, as UAE is getting more and more sophisticated in line with the OECD principles, this whole mixing of the beneficial and the legal, it will be really difficult. And of course, we are still waiting for more cabinet decision guidance to come out and see, what the letter of the law and what the spirit of the law, intends to do. But as of now, the ownership, it's basically the 95% vote and value. So it means both the legal as well as beneficial ownership as well. It cannot be just the one or the other. Saba, hopefully I was able to answer Mr. Fahmuddin's question.
Yeah. Thank you, Abi. We have more questions. I'll invite Farrukh now to answer a few. So what are they saying is that what is a qualifying income in free zone?
Okay, the qualifying income has not yet been specified. So hopefully we'll be getting a decision on that, which will be giving us an idea about the qualifying income. But probably if we just step back and see the consultation document, in that we have certain categories of the incomes. Example, if it is from within the same zone or from zone to zone, and if a company is operating in the zone and it is exporting from the zone, but still in the main CT law which has been issued, we are yet to be we are still awaiting this, and hopefully it would be clarified in due course.
Yes. One more question for Farrukh. Income from export of goods from mainland to rest of the world will be taxable or not? Kind of a free zone question.
Yes, yeah, even if you're exporting from the mainland, of course, it would be a taxable income because you are sourcing it from the state, and it's not like the VAT in which it is apparently zero rated income, but in this case it's your income and it would be taxed.
Yeah, so we have no exceptions right now for export, and it will be considered as any other normal activity if you're in the mainland, and if you're exporting or not, or you're giving a local supply, you will be charged a normal corporate tax rate as per your threshold, other rules. One question for you, Sadia: how will UAE source income of a foreigner? I will be taxed who doesn't have a PE in the UAE. Does the payer of that income based in UAE has any responsibility in this regard?
No, there are no withholding tax provisions. So there's no responsibility of the payer to withhold anything for a foreigners. So for foreigners, it is said that UAE-based income will be taxable. UAE-based income, if you're selling anything, sale of goods, things like that, for an individual, and for a corporation or a limited liability company, it would be something if they have a PE in UAE, or if they're earning any UAE source income, if there is a nexus to any income. So nexus has not been defined yet, but yes, it is said that if there is any nexus for UAE source income, that will be taxable in UAE.
So I guess the PE concept or the fixed establishment concept is quite critical, guys. I would request my other two panel members, do you want to add something to this question? They're trying to ask, and Sadia very rightly explained, but any other part of the PE FE concept, would you want to add some light to it?
Sure. Well, Article 14 of the law, permanent establishment, certainly is very relevant, because you may have a lot of companies, who are not established here, but who may be sending their employees, who may be having some, installation, who's here for the short-term project, what have you, right? So certainly, if let's say U.S. company sends an employee to UAE for a project, and let's say that project stays longer than 6 months, then technically speaking, you may have an employee PE where that person is here for greater than 6 months, right? So that can create a PE for that US multinational in the UAE. And likewise, let's say a company can have a construction project or what have you, and not only that, the 6 month is the test. You can have a construction project for, let's say, 3 months, 3 months, 3 months in a separate time. But technically speaking, if it's all part of the same project, then you can be saying, oh, it's less than 6 months, you're fine. You have to be adding all of them under the anti-fragmentation rule, where the genesis is that since it's part of the same contract, you cannot break it out. You have to add all those things together, in which case, you may have a PE concept. But anyway, this is more or less in line with the OECD standards of the PE definition. So clearly, the fact that UAE, as you may all know, is part of the inclusive framework, they have to abide by the 4 minimum action items. Action 5, economic substance, they're already doing the ESR reporting. Action 6, treaty abuse, preventing treaty abuse. UAE already has treaty with all those countries. Action 13, transfer pricing, which is C by C reporting, country by country reporting, they're already doing. And Action 14, which is a multilateral instrument. Even though BEPS Action 7, which has to do with the PE, is not part of the minimum standards, the fact that UAE has introduced this law clearly shows us that UAE is certainly trying to be very advanced when it comes to taxation. Of course, in order to bring the FDI in the country.
True. Thank you, Abi. We have some more questions. We will go back to them. Mr. Wahid Uzzaman is trying to ask that, can you guide us on the tax depreciation and accounting depreciation if it's an allowable expense? And what about the provisions of bad debts? So I'll give this question to Farrukh. If you can explain, Farrukh, please.
Sure, Saba. Indeed, an excellent sort of a question. So, apparently at present, we don't have any concept of a tax depreciation in UACT law. And it is a good news also at times that we just have to follow the accounting depreciation. So we don't have to calculate separately for any of the tax depreciation here. And the second thing, I think you were asking about the bad debts. Yes, at present, it is not specified again, so we can classify the provisions as per the applicable accounting standards as an expense. So in UAE, of course, in many entities, we are using IFRS. So if something is allowable as a provision for expense as per IFRS, unless otherwise specified, it would be treated as an allowable expense.
Thank you, Farrukh. One more question. It's for Sadia. For individuals like royal family members who are having income in their own name, like self-owned rental properties, like a personal, rental income, other than salary income withdrawn from government entities, and they have shareholding in like mainland entities. They are like also owners or partners in a company. Can we club mainland company tax laws with their individual tax gains, provided they will be registered as individuals?
Yeah, so in this VAT grouping, tax grouping is only for 95% shareholding. The individuals cannot be grouped with companies, but real estate, they have specifically mentioned that this is exempt from corporate tax. So for other income, if they're earning any other income, that will be taxable separately.
So guys, you have to see, as Sadia mentioned, and accordingly, you have to decide. You cannot group an individual with a corporate entity. One more question about the tax registration. I'll give it to Abi. A UAE mainland company wholly owned by foreign company, says Cayman Island, then we can do that. Oh, sorry. It's a question again. We have covered it. I'm really sorry. Another question. Do all free zone companies have to register for tax and also pay tax as well if exceeding the threshold? Question for you, Abi.
Well, any companies, free zone and the mainland, they all have to register. That's number one. And you may also say, what if, we're trying to consolidate all the, let's say, 10 different companies into, one grouping? Does that mean that you have to register 10 different times or just do one? The question is, whether you do the grouping or not, all the entities, free zone, mainland, whatever, you have to do the registration. That's number one. And let's say, well, for example, if the free zone company is only getting a qualifying income, a good income, you don't have to pay any tax. We only have to file it. But let's say a free zone company, but the questions we have to ask ourselves is, what if this free zone company is getting the bad income and let's say the free zone company has a bad income of 400,000 dirham. Does that mean that 375,000 dirham is tax-free because of the zero rated? But technically that 0% and the 9% is applicable mainly for the mainland companies, right? So the question we have to ask ourselves is, the moment free zone company starts getting a bad income, does this 0% and 9% also apply to those free zone companies or not? That's a devil in the detail we have to ask ourselves. But clearly, if a free zone company has only good income, then you don't have to pay any tax.
True. Thank you, Abi. So you have to register anyway. Sometimes you will be filing nil returns. Sometimes you will be paying and having some figures in your returns. Yeah, for free zone, things are complex right now. We are not very clear again. And I guess we will take some, implications as per whatever the industry is going for. And maybe we will wait for some more details if they issue some details about it. So another question where I would request Farrukh to put some highlight about the 9% rate, Farrukh. Is it like what they're trying to ask is that is it an overall rate? Is it a fixed rate to the net profit, or is it actually higher than 9% overall on an industry?
It is a flat rate, yeah. So it is a flat rate applicable to everybody. If you're a mainland entity and any income, any, you can say, taxable income which has been calculated as Abi has specified earlier in that sequence, and if it exceeds 375k, on that portion only the flat rate would be applicable, and it is applicable across all the industries.
Thank you, Farrukh. One more question. I'll give it to Sadia. What will be the impact on income of trust created purely for family business?
Yeah, so it's not clear, but charitable organization, it's said, and benefit of public, organization for benefit of public, it's said that will be exempt from tax. Family business is not clear yet.
Okay.
Saba, if you wish, I can definitely add on to it, as Sadia has explained it also. Family foundations, they have to apply for the approval to be treated as unincorporated partnerships, and if the approval has been accepted, or if it has been granted by FTA, in that case the family foundations will be taxed individually in the hands of the members. And if they will not be applying, and if they just kept silent, in that case family foundation, the income will be taxed entirely as in their own capacity of the foundation itself. So we have certain clarities here, but of course, as Sadia has specified, it would also be clarified in due course.
Okay, thank you, Farrukh. One more question. I'll give it to Sadia. What are the procedures for tax assessment? And in case of non-compliance, what type of penalties can be imposed? So they are looking for a very fast-forward future.
Penalties, they have said there will be penalties, but they have not yet given details. Like in VAT, they have a separate directive for penalties. I'm sure they will have a separate directive for penalties. Assessments, it is said to be self-assessed. Whatever you file declared is treated as assessment. But yes, they will have a right to audit your assessment. But those details, they have not been mentioned yet till now. They will be clarified in due course.
All right, thank you. Abi Man, one question for you. They are a basic question they are trying to ask, but a good one. If we have 400,000 profit, so tax will be on the 400,000, or it will be on the amount exceeding the threshold?
No, that's a great question. It's basically, so if you, assuming this is a mainland company has a profit of taxable profit of 375,000 dirham. So up to 375,000 dirham is a 0%. And for the remaining 25,000, it's taxed at 9%. That's it, basically.
So a very basic concept, but a very important one.
Yeah, very important.
Yeah.
I don't, yeah, exactly. You know, it's not that the 9% on the whole 400,000, right? But of course, in my earlier example, which we still need the cabinet decision, if it's not a mainland company, if it's a free zone company, and that free zone company gets that 400,000 as a bad income, is it going to be the same principle for the free zone company? As of now, until the cabinet decision says otherwise, you know, what I've been telling clients is more than likely in the free zone company case, which is getting the bad income, most likely the whole 9% will be on the entire 400,000, right? But again, that's $1 million question. We have to be ready to wait for the decision.
Sure. Thank you. One question for you, Farrukh. I guess we have a farmer here with us. Any exemptions to vegetable and fruit farm companies? Farm in Alec, but products sold in the entire UAE.
No, apparently we don't have any specific industry classification for the farms and any such businesses. So apparently, if you are a farmer and you hold such entity, it would be a taxable entity.
Okay, thank you. So it will be considered as any other normal business and no such exception, sadly. One question for Sadia. Is there any sort of tax credits concept in the law?
Yes, tax credits, we have foreign tax credits, withholding taxes when they will apply. Currently it's 0%, but foreign tax credits will be available. And then deductions, I think Abi explained them very well, all the deductions that tax reliefs that we can have.
All right. One more question. What are the procedures for tax assessment? I guess Sadia covered it already. It's defined in the law and there are penalties, as she mentioned. If free zone company sell goods to mainland company, but mainland company pay custom duty and VAT, will it be considered local sale or export for free zone company? I guess Sadia, can you please cover this one?
Yeah, sells good to mainland company, but the mainland company pays. Yeah, it will be considered. Look, payment of VAT and custom duty will not change the nature of income that is being earned. The nature of income is that the sale is being made to a mainland company, and it will be considered as mainland income. Most probably, it will be taxed as non-qualifying income.
All right, thank you. We have one more question about the threshold. I guess Abi has already covered it. So Shazad, if you have 380,000, then in a mainland, you will be, only paying the tax above the threshold amount and not on the full amount. But for the free zone, you will have to wait or consult somebody. We have one more question. I work in insurance broker industry. One of the major expense is commission or incentives to sales staff. It is accrued on a monthly basis and paid next year based on achievement of annual targets. My question is, commission expense is admissible based on accrual, or will it be admissible when actually paid? I'll request Abi to answer this.
No, sure. That's a great question, right? First of all, our starting point of our taxable income is your IFRS book income. So, unless you are a small business taxpayer and unless, we have more clarity, right now you are expected in accrual basis, right? So in this case, it's on accrual basis, not necessarily on the payment basis, right? And I know that in other jurisdictions, for example, sophisticated jurisdictions in US, right, you can be paying the bonus, let's say, by March of the next year, and as long as certain conditions are met, you can still try to get that deduction in the earlier year. But unfortunately, right now, the law is not very clear on whether it allows the cash basis method. So as of now, the commission expenses, assuming it's a valid and commercial and justifiable expenses, will be deductible based on accrual basis, not when it was paid.
All right, thank you, Abi Man. Farrukh, one more question. I'll give it to you. Is there any withholding tax on dividend or interest? Although Sadia have covered it before, but if you want to add more light to it, also, is there any withholding implications on share buy, on the buying of share?
Sure, I believe Sadia has already answered it also. So at present, we have the withholding tax at 0%. So if you see, technically it's not currently applicable, but in future, if, I expect that as and when the rate would be specified, we will get also extra, clarification on that on which industry it would be applicable. But at present, in UAE, we do not have the withholding tax, you can say, effectively applicable.
All right, thank you. So many people have commented in our chat box that they are very thankful, and the overall discussion have made a lot of their concepts very clear. And I would say we had a very good input of question and answer session. I have one last question for Abi Man. Abi Man, would you want to give some light on the concept of global minimum tax? I know it's a big chapter, but just to give an overview to our participants and whoever is attending the call with us, and about the anti-abuse rule. When you talk about it, there was a question as well which I haven't asked, that then if there is a rule of anti abuse, then how can we do the tax planning? And if we even do, let's say, for example, if we make a free zone company just to have an export and take benefit of the corporate tax rate, then will, again, going back to the global minimum tax, will it even be beneficial?
Wow, these are all very loaded questions, Saba, right? So certainly, of course, a general
Sorry,
anti-abuse
this is from me.
article.
Okay.
No, exactly. No, these are very. I think I have to send you a bill for that now, Saba. Just kidding. So basically, from anti-abuse rule, yes, certainly, as I said, as long as you can justify that the planning you are doing, the tax planning you are doing, are not purely for the purpose of saving tax. You have a business reason, you have a legal reason, you have a commercial reason. As long as those are properly justified, then you should be fine, right? But if you're purely doing just from a tax planning, then certainly you may be challenged by the tax authority. So that's the question on general anti-abuse rule, number one. And the most important topic, of course, as we wrap up this webinar, is understanding of the Pillar 2 or so-called global minimum tax, right? Of course, we have to keep in mind that this rule is not applicable to all the taxpayers. It's applicable to only those taxpayers, those multinationals that have a consolidated gross revenue of over 750 million euro and that have a cross-border presence, cross-border transactions, right? Now, right now, we know that the global minimum tax rate is 15%, but UAE's tax rate is only 9%, right? So you have to look at it from two angles, meaning UAE company having a presence outbound, or we have to look at it from an inbound angle, where such as a US multinational has a presence in, that's a US or the foreign multinational have a presence in the UAE. That's called an inbound. So this is where I would like to separate things out. But as we stand here today, the law clearly says that as of now, they're still working with OECD to see whether the 15% will come in or no. But right now, we only have two rates, 0% rate and 9% rate. So that's what it is. And certainly, if you are a large multinational that are subject to Pillar 2, you can't just think only from a UAE corporate tax perspective. You have to think from a global minimum tax perspective to see, because let's say you have a US multinational or UK multinational, whose tax rate is clearly higher than 15%, which owns a UAE subsidiary, which taxes 9%. What's going to happen to this delta of the 6%, right? So who's going to get the tax? That is $1 million question. But I think that at least there's one good news, which I'll probably leave it with a suspense for future discussion, is UAE is also in talks, along with the other international communities, about to see whether the introduction of this new thing called QDMTT, this is something called Qualified Domestic Minimum Top of Tax Regime. It's basically a mechanism where even if there is a top of tax that has to be paid, rather than that top of tax to be paid in a foreign jurisdiction, the home country jurisdiction, such as UAE, or Qatar or KSA, they will get the taxing right on the top of tax. Again, as we talk every day, as we are here every day, we get a lot of updates from the OECD, but certainly for the large multinationals, talking about UAE tax without talking about Pillar 2 will be an incomplete conversation. That would be my 2 cents about it.
Thank you, Abi. Yes, and that's why I wanted you to say something about it, because when you talk about corporate tax, it's incomplete if you don't talk about Pillar 2, if you are a big multinational and if you meet the threshold, and maybe not even you're meeting some other conditions. As we started a little bit late, I'll take one more question before we close this, or two more questions actually. So I have one question for Farrukh. Please elaborate investment manager exemptions. Farrukh, this question is for you. If you can answer.
Yeah, are you able to hear me?
Yes, now we can.
Okay, the investment manager exemption, of course, is that see, investment manager is basically handling the investment of a lot of individuals who may be in this country or who may be outside the country. So his exemption basically, exclude all those individuals whose income is being handled here or whose investment is being handled here by the investment manager who is inside this country, that the PE of whose investors, it would not be triggered. So in that case, the investment manager, are you able to hear me?
Yes, slight disruption, but yeah. So we heard that, but you're mute. So meanwhile, Farrukh catches up. Sadia, would you like to explain more about the investment manager exemption? Am I mute? No, I'm not. Sadia, can you hear me?
I can hear you, Saba.
Yeah, please. Yeah, back to you, Abi Man. Please explain us the investment manager exemption. I guess they are trying to ask about this PE concept, that if does it trigger the PE or not. I guess that's what they're trying to ask.
Yeah, like the investment managers, like fund manager, right? For example, in the US, we have these BlackRock or Fidelity and all those things. These are the investment manager, right? Certainly, what's trying to say is there's a UAE-based investment manager that is managing the portfolio of, let's say, of a UAE customers. Then clearly, UAE customer, the UAE company already has a taxable presence here. But if the investment manager is managing a portfolio of, let's say, US or the UK based portfolio, let's say BlackRock or Carlyle or Blackstone or what have you, all it's trying to say is that as long as the investment manager is not the sole dependent agent only of that one foreign entity, you are an investment manager of all other companies. You can be considered as an independent agent, and therefore, just because the investment manager is providing a service on one of your foreign customers, because of by him being here, he's not going to create a PE, right? So that's what's basically trying to say. It's basically covered under the Article 15 of the law.
Yes. So Adnan Ramzan, who asked this question, Adnan, so you have to be very careful, as Mahar, Abi Man explained. But first you have to see, is it a public investment manager? Is it doing the fund managing services for other companies as well? Or is it just created by your holding company to manage a certain SPV outside UAE? In that case, you will have to see the PE implications. Otherwise, you will see that, if it's a public fund manager, then you can have the exemption most probably, but you will have to see the conditions of the exemptions. So a lot of people are asking me that can we have the presentation or the content we have talked about. Guys, I will talk to the team and I'll get back to you. It's kind of a personal work of Abi Man, and really thanks to him for the involvement in taking this much time. He's a partner in Deloitte, and you cannot expect this from all the partners, but we will get back to you on that. I don't have a clear answer for that right now. One last question I will take from Hassan. Most mainland entities have local sponsor holding 51% of the share, and they get a sponsor fee with the local sponsor subject to corporate tax as well? It's their question. I'll repeat it. So they're saying most of the mainland entities have a local sponsor holding 51% of their share. And that, local sponsor, they get a sponsorship fee. So will that sponsorship fee will be subject to corporate tax or not? Sadia, can you please answer this for us?
Yes, actually, for individuals, there's going to be a separate cabinet decision which will come, which will mention all the incomes that are subject to tax. So a sponsorship fee is not written anywhere if it will be taxable. Only it is said that business activities will be taxable. Whether it is to be considered as a business activity or not, I think it's a little gray. So I'm sure in the cabinet decision they will clarify as to if sponsorship fees can be taxable for corporate tax purposes.
Thank you, Sadia. So we have covered like all the questions, and I guess it was a very informative session today. I'll wrap it up by thanking all of the members we have today present in the question and answer session, and especially Abi Man to take us through the whole corporate tax journey and explain all the basic concepts very, in a very good manner. And Sadia and Farrukh to be here as a panel members. And guys, thank you for a very good participation from the participants. It was really a good discussion today. So sorry, we had some glitches in the start, and I guess we managed to take it through and got it sorted and answered whatever you were having in mind. So we'll wrap it up now. Thanks to all of you. Mirza Farrukh, you want to say
Thank
something?
you very much.
Yeah.
I think
Farrukh,
it
you
was
want
a
to
great
add up?
session. And
Yeah. Please go.
Are you able
go
to hear
on.
me now?
Yes, we can. Sorry, go on.
Okay. Indeed, it was an excellent session. I think I have also learned a lot with this. Sadia's opinion, Abi's opinion, and of course, Saba, you have done an excellent job in having a long session and appropriately answering all the questions. So thank you very much, all the guys. I look forward to the next sessions also.
Yeah, me too. It was a very informative session, and being in the industry, we learn a lot when we talk. Thank you, guys. I'll sign off now. Thank you, Abi Man, for especially coming and taking out time for us. And Sadia, thank you so much. And all the ICAP members who helped us arrange this call and put it through. Thank you so much. Thank you, guys. Bye-bye.
Thank you all. Bye-bye.